We're having a good time. We're having a good time. On the Money Watch, as we start the new year, anticipation is high after the, like out there in Hollywood, after the Federal Reserve announced that we could see 3 rate increases in 2017. Interest rate hike will affect anyone with a home mortgage, a car loan, savings account, or money in the stock market. So what does all that mean for your wallet? Well, we got our certified financial planner, Joe Bert, joining us now with how those rising interest rates could affect your finances in 2017. Joseph.
Good morning. Happy New Year.
Good to see you.
Good to be here.
You know, some of the financial people that I've talked with seem excited about the prospects of what the economy is going to do in 2017. But when you raise interest rates, doesn't that kind of, squelch people's desire to invest? Or
Well, what happens is we're particularly concerned about what's going to happen with housing.
Okay.
Now, Janet Yellen raised interest rates on December 14th, a quarter of a point. That doesn't affect housing directly because that's tied to the 10-year bond. However, if we have a continuous trend of rising interest rates, it's going to put a cramp on housing because it makes housing less affordable for particularly the first-time home buyers. So that's the big. However, if you have rising interest rates, it says that the economy is doing better. So people are more. That's what's going on right now. We have a lot of positive feelings going on about what's going to happen with the incoming administration, and that's why things are doing what they're doing.
I tried to hang in there as long as I could on that one. When you lost me, if you're curious, it was right around, you said housing. Right around then, I was kind of like, ooh, I need a flow chart to figure all this out. All right, what types of debts are impacted, though, by these high
rising interest rates? What we're going to have is rising interest rates on your credit cards.
Okay.
HELOC, home equity lines of credits are going to go up. Automobile loans are going to go up. So that's going to impact the people's ability to buy things, and of course, it's going to take money out of your wallet.
But again, like you're saying that, it impacts people's ability to buy this. We want people to get out there and buy stuff.
Exactly.
So isn't this going to...
Well, this is why the interest rate has been kept low for so long, is because the Fed has been trying to stimulate the economy, keep interest rates low so people buy stuff.
Exactly.
But now they think inflation is coming back, the unemployment is low, so the idea is we want to be ahead of the curve and raise interest rates so we don't have large inflation. So they did it. And then they expect to do this 3 more times next year, it's projected.
All right, let me ask you this. What do I do with my money if I'm not out there buying a house or I'm not out there buying a car? Do I then run to the stock market?
Well, first of all, your excess money should always be invested. You don't want to keep it idle, don't leave it. You need to have emergency money in a savings account. But once you've done that, we always tell our clients the first thing to do is look at plan for retirement. The best thing to do is max out your contribution, your 401k. If you don't have access to a 401k, put it into an IRA, use mutual funds, put it in growth stuff, and you'll be fine. But you don't want to let it sit idle, and particularly in today's low interest rate environment.
This just occurred to me, see if you like this.
All right.
If you're doing nothing with your money's doing nothing for you.
I like that.
Do you like that?
I can use that.
It just popped into my head.
I could use that's very good.
It comes at me, flying at me. I tell you what, can't even fight it off.
We'll use that again.
Joe, always good to see you. How can we find you, by the way?
Just Google me, 2 words, Joe Bert, B-E-R-T.